Hello and welcome to LiveSquawk's Market Talk. We're previewing today's FOMC meeting with a couple of special guests. With me today I have Joseph Choi, author of The Curve Advisor, and Christian Putz, founder and CEO of AR Investment Partners. They won last year, I think, the HFM European Performance Awards in the category of global equity under $500 million. Hello and welcome, guys, to today's episode. Just before we bring the two guests in, I will just go over the usual disclaimer. The content provided on this channel is for the informational and educational purposes only. We are not licensed financial advisors, as none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your own financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We're not responsible for any losses or gains that may result from following the content on this channel. And with that, I'll bring in my two guests. Hello, Joe. How are you?
Hi, fine, thanks. Thanks for having me on.
No, always a pleasure. It's always insightful having you on for events such as this. And Christian, first time guest, welcome to the show.
Yeah, thanks a lot. Really happy to join in, especially at such an event as today.
Awesome. Before we get into our guests and their views, we'll have a quick look at today's main event. We'll have a look at the FOMC, but we'll also have a look at the general state of affairs for the US predominantly, and anything else we think of that's relevant. But so FOMC main interest rate decision tonight. Consensus is for a hold, which will keep rates at 4.25%, 4.5% window. Just a note from Barclays here, they expect the Federal Open Market Committee, or the FOMC, to stay on hold for a third consecutive meeting in May. We anticipate changes to the opening paragraph of the statement to acknowledge the slight decline in measured GDP in the first quarter, while noting that consumer spending and fixed investment continue to grow at a solid pace, the bank said. We also expect the committee to introduce new language highlighting increases in some market and survey-based measures of near-term inflation, alongside survey indicators showing weaker sentiment and elevated uncertainty about the outlook among households and businesses. We do not foresee any changes to forward guidance, which currently ties policy moves to incoming data and broader policy developments. Given the prevailing uncertainties, we would be very surprised if Powell or the statement explicitly mentioned the possibility of a rate cut in June. So that's a note there from HSBC, Barclays. So I get that right. And just I'll bring in a new guest first. Christian, firstly, tell me a little about yourself and how you have become this fund manager and founder of ARR.
Yeah, sure, definitely. How long do you have time?
Or just a brief overview of that. We can always come back to it another time.
Yeah, sure, definitely. So, I mean, I started investing quite early in the 90s when I was 17, and my interest really got sparked. And then after my studies, I worked for main investments in London and in Switzerland. I'm originally from Austria. Then I think what is quite unusual, I moved to Russia. I worked in Moscow for an American hedge fund. Went through quite some pain there in the very prolonged bear market from 2011 till 2014. And then in 2015, I decided to launch my own hedge fund strategy, a global mandate with the focus on making money in bear markets and market corrections. And, we started very small, one investor in my own money. And since then, we have grown quite nicely. A very diversified investor base, are based in London, and really help high net worth individuals, family offices, charities, and so forth to navigate difficult market environments.
So I guess the environment we've seen this year, and we've talked about this before between ourselves, has been an interesting year for you, coming from the perspective of your fund and the way you manage your fund. If we take a quick look at today, we'll come back to that in a minute, and we'll look at the bigger picture for the US economy and global economy in a bit, and the markets. But first of all, just to today's FOMC interest rate decision. There's no surprise we're looking for unchanged here. Are you looking for any particular angle or any particular message from the Fed at today's meeting?
Not really. I mean, I think today, I mean, obviously, today it seems like, I mean, at least when I look at the FedWatch tool, right, there's a 98% chance that, there will be no change. And for that reason, obviously, if there is a change, that would definitely move the market significantly. So if anything, the only thing I can imagine, or, if they're big move, if they decrease the interest rate, then I could imagine that, despite the fact that we already had quite a big rally over the last weeks, I mean, a lot of people might be, caught on the wrong footing, and the market might, go even higher. I mean, that's something that could happen. But personally, I mean, I don't expect that. But, we definitely are prepared for all the different scenarios so that we can react timely, I would say.
Okay. Joe, what are your views on today's decision?
Oh, yeah, I agree. I don't think we get any major change today. I mean, maybe there could be some tweaking of the language. The Fed's going to want maximum flexibility, so I don't think they're going to want to say anything to get boxed in. What I did want to talk about, though, was the market expectations. Powell was very hawkish the last time we heard from him, almost a month ago. So the overwhelming market consensus seems to be that we get more of the same. And while there's no doubt that anchoring inflation expectations is important, I'm actually wondering if there can be a change of tone from the sum of the following three items. So number one is we did get a negative GDP print for Q1, and it's probably a coin flip on getting a negative GDP print for Q2. And so that may or may not be an official recession, but that optically would look terrible. Number two, we also got a benign PCE print. Generally, the Fed doesn't make a big deal out of one print, but due to some potential overstocking, it's not implausible that we get another.
Right.
But yeah, and number three, the main factor that would cause a slight change of tone from Powell is that the Beige Book came out a week after we last heard from Powell, and there were some passages in there that were especially weak. So the next two quotes are directly from the Beige Book. So the first one is the outlook in several districts worsened considerably as economic uncertainty, particularly surrounding the tariffs, rose. And then the second is both leisure and business travel were down on balance, and several districts noted a decline in international visitors.
Right.
So in the past, there had been a correlation between Powell's tone and the Beige Book. And in these strange times where the soft data and the hard data are giving mixed signals, it is possible that Powell may be relying more on empirical information. So to be clear, I also expect Powell to be firm on anchoring inflation expectations, but that's, in my opinion, already priced. And everyone is expecting Powell to be hawkish. But I'm wondering if, since the Fed has two mandates, I'm curious if there'll be some more nuance in Powell's assessment of the inflation risks versus the growth risks at the presser. So I'll just be listening mostly for tone changes.
Just in terms of tone changes, talking of which, Waller, and we heard from Waller, was it last week or the week before last? It's all melt into one now. And again, he's seen as a stalking horse for the top job at the Fed, so maybe that was in his thinking in terms of the way he is. He was seen as a hawk, but has come up recently with a slightly more dovish tone and was willing or open to the idea of potentially easing rates. Again, I've got a note here from Danske Bank that says that Christopher Waller who has often been seen as the consensus voice of the committee, took a clear step towards the dovish camp by firmly labelling tariff-driven inflation as transitory and by warning against recessionary signs emerging in the second half of this year. And then the bank notes that others have sounded more cautious and called for patience as the negative supply shock on imports and rising consumers' inflation expectations bring back uncomfortable memories from 2021. So along the lines of what you said, Christian, in terms of how you view not just today, because I think we're all pretty much of agreement that today's I wouldn't say a dud, but we're looking for very little in the way of new information from the actual statement, at least, and the rate decision. Maybe Powell will want to give a bit more away, but we know he's not prone to doing that unless he really has to. So where do you see the angles here, Christian, in terms of how you'd approach not just today, as I said, but the coming 2 to 3 meetings?
Yeah, I mean, currently, obviously, I would be, I'm mostly an equity investor, right?
Right.
So we invest in long, short. We obviously have given our global mandate, the freedom to move wherever we want into the markets we like, and also into the sectors we like. Currently, given all the uncertainty, we are very cautious, and rightfully so, I would say, because the picture is not clear, and depends on many factors, I would say, that are very unpredictable. For that reason, to have a very strong view on certain outcomes, I think, is misplaced, because one of the things that will have a big impact on inflation policy and so on is the whole tariff war between China and the US. And although I think the market now prices in that there will be a significant reduction in the tariffs, that has to be seen. And normally those kind of negotiations, can go on for very long, and so forth. So for that reason, on my side, what we do is simply we focus on ideas that are, more company specific, and we have relatively little netto exposure. Net exposure, meaning, it's not like that we have we have more balanced books of longs and shorts.
Sure.
And many of those companies, they're not affected by
day-to-day swings.
Yeah, exactly. Well, they are definitely day-to-day swings, but it's less. They're less affected by, than tariffs, or whether then the interest rate is 0.5% higher or lower. That will not be the big determinant of the share price development.
Sure. Joe, just in terms of, again, we were looking wider than today's meeting, the pricing, as you mentioned, and as seen on, I think someone sent me yesterday's swaps markets here. It's kind of split between June and July. I think a few more people are now favouring July as a meeting. There really is no rush at this point to take any action, is there? There's no imperative to move unless we get something out of the ordinary from the White House, is there?
Yeah, I think a lot of people are expecting the data to start, the hard data to start softening noticeably as the summer progresses. The timing, I'm a little uncertain about, but so I agree with Christian in that in the short term, it's tough to have a strong view on this market. Like, for example, just yesterday, we saw the EU propose retaliatory tariffs, and fixed income rallied and equity sold off. And then, later in the day, we had news of the US-China meeting, and fixed income sold off and equities rallied. So we're, in the very short term, we're at the mercy of headlines. But I did have a big picture view, and then just some things I'm keeping in mind in the medium term. So in the bigger picture, I had a post a couple of weeks ago titled "One Battle, Lost War." And because Trump has trade deals out there for the taking that we didn't have before, so we won the battle, and that we'll probably gain from some combination of tariff income on imports, foreign investments in the U.S., which may or may not eventually happen, lower tariffs on our exports, lower non-tariff barriers on our exports, and some other concessions. But we lost the war in that we alienated a lot of our customers, like international purchasers, foreign travelers, and foreign investors, for probably at least the next 3.5 years while Trump is in power. So it doesn't really matter, in my opinion, if U.S. goods and services are 10 to 20% cheaper than before to foreigners, when when we've offended our customers to the point where they refuse to give us 100% of their business. So, we hear anecdotes of this from destocking U.S. liquor, boycotting Coca-Cola products, refusing to travel to the U.S., or even investing in U.S. assets. So I think this is the reason we could see a prolonged period of economic weakness that people aren't thinking about. And even getting a deal done may not resolve this pressure, because if someone insults you, you're not going to be, happily going back to them when they reopen for business. And then
Do
I
you
guess in
honestly
the
think it's that febrile? Do you think it's that we've got to the point now where the US is tainted by everything that's happened, and we, like you say, it's going to take a while for this to turn around, the sentiment to turn around, and for people to start loving the US again. I always, the US for me is ever present, in culturally as much as anything else. In the UK at least, we watch a lot of American content, and we'll go into the 100% tariff on films, but we watch a lot of American content. There's a lot of US culture embedded within the UK economy for sure, and potentially in Europe. I can't talk for Europe. Maybe Christian, you can give a bit more of a view. I think less so in Europe, and it's like a slow-moving tanker. Surely that's going to take a while for that to ebb. And what I think you're saying is that's being chipped away at the moment, Joe.
Oh yeah, so I think the issue is even if we get some kind of trade deal, Trump is going to be out there all the time. And so I just think, so even though I also, so like Buffett famously said, never bet against America. So I'm not saying to bet against America, but the thing is if you own, an apartment on Central Park South with a view of Central Park, but Chucky signs a lease for 3.5 years next door, I'm going to think twice about how awesome my apartment is. So I just think that because of Trump's personality and because he's going to be in the news all the time, I just think that's just going to be a reminder to everyone, for the next 3.5 years that, of what happened. And I don't know that we're going to be so easily forgiven until he goes out of office and he stops being in the news cycle.
It's a good point, Christian. From a European perspective, I know you're based in the UK now in London, but from a European perspective, do you get the same sense from abroad?
Yeah, definitely. I think you see it also in the hard data, right? When you look at the travel data and so forth, that far less people are traveling to the US, and there's another thing. Obviously, everyone seems to boycott Tesla. I mean, when you look at the car
I was
sales,
about to say it's the Tesla syndrome. The Tesla
exactly.
syndrome.
So there's definitely an element to that for sure.
Okay, right. And if we look at, I guess, Trump and the US economy from here on in, then if we're looking, and we don't want to again to look too far ahead. We already saw the contraction. a lot of people put that down to the import, like you say, the trade issues and front running, really the tariffs. So again, I don't think there's as dire as maybe something. I mean, that is in terms of what I've read up on in research. So there is some light at the end of the tunnel, and I think there are varying views because of this uncertainty as to how much we'll see the US economy moderate going forward. But we saw with the jobs report last week that although the headline was stronger, the revisions really told another story. And I guess March, April rather, is a murky time, I think, for collating jobs data. But ultimately, what I'm trying to get at, what are the bits of hard data, at least, that you're looking at then, Joe, in the near term to give you any kind of tell as to how deep this sentiment runs? Would it be are you sticking with the jobs data as prices, or are you looking at the soft data in terms of the PMIs for a better view ahead?
So some of the better economists on the street have pointed out that there's really no reason to expect the hard data to fall because the tariffs haven't, the hard data is usually backward looking, and the tariffs hadn't really taken effect yet. And actually, if anything, companies and people stockpiling for the tariffs may have actually caused an increase in activity. And so most economists who correctly made this call that the data would fall off soon are calling for the hard data to start falling off starting, maybe as early as this month, if not, sometime over the summer.
Sure.
So I guess the way I look at the yield curve is, we're at an interesting point where the markets are fully pricing in a return to the neutral rate. And so for me, the question is, at what speed do we get there based on a combination of the inflation and growth effects? So what I'm looking at in the medium term, because in the short term, it's just very hard to figure out what's going on. I'm thinking about the following things. So the first is that, I don't think the economy is going to break from the current baseline 10% universal tariffs because it's just 10%. I mean, that's basically what most of the countries have on. Now, China could be a wild card as there could be supply chains that may be affected. So resolving most of the escalated dispute with China could reduce some of the tail risk. The big near-term factor would be the second round of tariffs coming in early July. My read of the situation is that Trump is not getting the deals that he's looking for. And that's why he seemed so agitated yesterday when the reporter asked him how many deals.
Is that your guard dogs telling you that there's someone at the back door?
Well, no, I think it's because I mentioned Trump, but yeah. So Trump may talk the aggressive talk around the deadline. So
Sure.
that's something that I have in the back of my mind. But at the end of the day, Trump always has the option to take a bunch of trivial deals and claim victory, like he did with the USMCA. So it's unclear when Trump may decide to use these wild cards. So these are some of the things I'm thinking about in the medium term, while I evaluate the news and the market pricing.
That's a very good point. To that end, we had Besant on earlier a couple of hours ago. We're still speaking now, and sort of said he didn't want to reveal. We don't want to reveal the deals we're nearly at the end with because we don't want to spoil them. It's almost like that we know you haven't done any real tangible deals yet, so just quit pretending and just tell us when we actually do get some deals. We thought we'd get a deal with Japan done by now, or they thought they'd get a deal done with Japan by now. They haven't. The UK potentially is close, but UK really isn't that big of a deal for the US. And we heard from Carney yesterday after his meeting at the White House with Trump, and that looks a bit more promising. in terms of they're saying the right things if the action isn't ultimately there yet. So we have a lot of these very near or supposedly very near deals coming to fruition. But like you say, a lot of them are around a 10% mark. So does that really move the needle in any particular direction? So we will be looking at the Eurozone, for example, and I know the Eurozone is readying some measures if it doesn't really see what it likes. And it's always surprised me from a Eurozone perspective why they don't back themselves more a lot of the time. They've been very conciliatory with their chat. Probably the right thing to do because, they're diplomats. But, an economy the size of the Eurozone has some clout, and I don't understand why it doesn't flex a bit more than it does at someone who we were told respects flexing, if I can say that. Christian, from the Eurozone perspective, do you think, what are they so worried about in terms of, and I know it's a dumb question because obviously no one wants a trade war, but what are they, why are they more reticent to sort of flex, do you think?
Yeah, I think the issue is in general that we have in Europe is that you have so many different countries, so many different interests, and for that reason, there's not one strong leadership there. I think that's the main reason, right? Everyone makes their own deal or tries to make their own deal, and there is no consensus, and everyone has a different view and different interests, and for that reason, it becomes very difficult to stand up against the US as one entity. And I think that's the main reason, and probably that will not be solved anytime soon. So yeah, I think the US also understands that very well. And
they're not blind or deaf, or they do, and they've seen the fractious nature of debate in Europe of late. Although I did see today Merz and Macron becoming sort of buddies and trying to present a united front of Germany and France, as we used to get between when Merkel was in power. So maybe we're starting to see a bit of reunification on the top table for Europe anyway, but we shall wait and see. Anyway, just to recap then, as we're coming to the end of the half hour now. So tonight's FOMC decision, we're not looking for any change in the rate itself, keeping that corridor of 4.25%, 4.5%. There's no rush to adjust. Again, we expect Powell to reiterate some of this. There may be some change to some of the messaging in the opening statement, but we think, and the markets think, the forward guidance will pretty much stay as it is. We've got sticky inflation, we've got a resilient labour market for the time being, and the Q and the growth picture maybe not as dire as something, but there is, as Joe's alluded, potentially some worries down the line and maybe some entrenched anti-US asset investing going on at the moment. So we'll wait and see whether we'll see Powell fronted about that. I think if anyone wants to ask him about Trump again and his job, I think he's put that one to bed. He's in for the long term until his term ends anyway. So we'll put that to bed. It'd be interesting to see really post the FOMC commentary from other Fed officials, and if anyone jumps to Waller's side of the fence post today's meeting. Anyway, thank you for joining. Anyone who missed the start of this, you can listen back on YouTube, on X, or wherever you listen to your podcasts. We will also put this up on all the main podcast stations, Spotify and Amazon Music, among others. So please have a look for us there. I'd like to thank my guests, Joseph Choi of Curve Advisor. Thank you very much for your input today.
Oh, thanks for having me on.
Always a pleasure. And Christian Putz, founder and CEO of AAR Investment Partners.
Yeah, thanks a lot.
Pleasure. Someone's in the background. So I'll finish the broadcast here, and just say thank you for listening. As I said, you can catch us again on those platforms, and we'll see you again for the next one. Oh, just a reminder, tomorrow Bank of England, and look out for a written preview of the BOE rate decision, which is out at midday London time, 11 GMT. Thanks for listening, guys, and we'll see you again soon.
Thanks a lot, Harry.